Well, earlier this week, we were joined by Pankaj Tibrewal, and he made some very, very valid points with regard to the earnings picture. So I said, let's take that forward. Keep in mind that we're getting into a weekend, so you need to party. But when you're getting a little bit high, then it's a reason to be cautious, right? Similarly with the Nifty, at these high or elevated levels, there is reason to be a little bit cautious as well. Well, the MSCI India Index has outperformed the MSCI World Index by a large margin, and the gap out there is widening. And India is not cheap. 22 times on a PE basis, on a market cap to GDP basis as well, we're not cheap, and earnings have been pulled back by only around 5%. Now, looking at the earnings picture, you'll see that the Nifty 50 earnings picture looked pretty good. But if you look at the NSE 500 companies, a third of those companies, they delivered an earnings degrowth. The NSE 500 companies' earnings, in fact, the degrowth was closer on 3%. And stripped of the BSFI companies, well, the degrowth was more than 25%. Now, on the top line, things look good. Close on 44% of those companies, well, they delivered their best ever revenues in a quarter. However, the number of companies that delivered their best ever EBITDA or operating profit in the quarter was only around half of that. Only around 22% of them did deliver their best ever operating profit, telling you that the top line growth didn't really translate into operating profit growth. Moving to the cash flows then, well, there is a clear sense of deterioration out there for the BSE 500 private companies. And that's because, you have the working capital that's seen some bit of deterioration. We're looking at the deterioration close to around 60% of the BSE 200 companies. Well, they did see some bit of a deterioration. And the problem is, with this sort of a deterioration, will it have an impact on capex? That's a question mark. So for the time being, enjoy the party, but at these elevated levels, well, some bit of caution on the earnings front is warranted.
All right, that's very interesting, Nigel. Thanks very much for that. Let's put this to Ashwini Agarwal, who's now joining us right here. Ashwini, it's always a pleasure. Great to see you.
Thank you.
Again
Thank
on
you
the
for
program.
having me here.
I mean, some points on overall corporate profitability and how it's been a mixed kind of a picture.
Yeah.
What's your sense, and how would you look at this?
So, you have to actually get a bit deeper into the weeds, because what's happened is that there have been a lot of cost pressures on account of raw materials, on account of energy, on account of transportation, and some of these cost pressures are visible in the earnings that you've seen over the last 2 quarters. But some of these places you will see an improvement in margins going ahead, because some of the high cost inventory of raw material has been now exhausted. Some of the supply constraints have gone away. Transportation costs globally have started to come off. So some of these benefits will start to come through. Of course, what you will also see is some of the export demand fading away. That will happen. But on the whole, when you look at the aggregate numbers, they hide as much as they reveal. So I would actually go a little bit deeper and say that situation may not be as bleak as some of the aggregate numbers suggest.
Ashwini, you made a very interesting point in the break that you're not too overly cautious on the market.
Yeah.
And like lever in the last 10 years, India's multiple will keep re-rating.
That's right.
Can you just take it just to explain our viewers what do you mean by that and how you think the markets are going to be in 23?
So I have this philosophy that in markets, whatever is in scarce supply goes up, right? Over the last 12 years, quality was in scarce supply, growth was in scarce supply. So the multiples for these two factors just went through the roof. In a global context, India is now in a situation that it's one of the few areas where there is no macroeconomic imbalance, there is growth coming through. So the relative outperformance of India is explained by that. And in that sense, to look at valuations alone, maybe making the same mistake that people like us did as value investors by ignoring levers about 5 or 7 years ago, and the valuation kept expanding and we kept thinking, why? And that might come through for India as well, unless some macroeconomic accident happens to us or energy prices again go through the roof. So, I'm assuming that macroeconomics for India will continue to remain stable, and if they do, then I think valuations is something that investors will choose.
Although there is one small difference, last 5-6 years, interest rates, the risk-free rate of the world, the US 10-year was 0% or zero bound.
Right.
It is 5%, or closer to 5% now, right? And it's not going to go back to zero in the next at least 2 years. I mean, we don't know, but should we expect the same kind of valuation re-rating that you're talking about with regards to HUL?
So you have a great point. So you can't obviously expect that level of valuation re-rating, and interest rates will continue to go up from here by at least another 100 basis points over the next couple of quarters, both in India and in the US, is the general consensus that one hears. But at the same time, what I'm trying to say is that focusing only on aggregate valuations may be a mistake, because those aggregate valuations again have disparities within them. So I'm saying that India is in a great place. There are plenty of good bottom-up stories out there. There are one-off earnings pressures which might go away over the next couple of quarters. So I wouldn't be too bearish. Yes, a correction is possible. Markets look expensive. Individual stocks may be looking expensive. It's like this. Over the years, I've started to see valuations in the context of history. Yeah. So if you look at valuations in context of history, they're expensive at an aggregate level. But individual sectors are not expensive, individual stocks are not expensive, and that's the only caution I would provide to an overly bearish view.
Yeah, no, and Ashwini, a very valid point. I mean, to justify India's move, we have had billions of dollars of sale from the FIs, and yet we have stood our ground. Not Correct. Just that, I mean, we have a stable government now, and crude oil prices have cooled off as well. So those factors are moving in our favor. My question to you is, earlier in the show, we were discussing about these new age themes.
That's right.
A lot of supply coming in there. November rain. It rained, but it got absorbed as well.
Absolutely.
What's your sense on these new age themes? Are they coming to some level where they'll generate interest, or do you believe there is still some pain ahead?
So very difficult to say. As you said, that valuations are now in the ballpark of being interesting. Okay, now whether you see another 20% drawdown or 30% drawdown, nobody can say. Yeah. Okay, that's impossible to say. But last year, towards the end of last year, at least when we were looking at some of these companies, we had no idea where the valuations were coming from, and we kind of stayed away from investing in any of them. And now I am looking at them. Have I invested in any of them? The answer is no. But am I looking at them? The answer is yes. I'm looking at them. They're looking very interesting. I don't know where the bottom is, but they're looking very interesting.
You want to give us a hint? Which side are you drifting among those five, six names?
I'm not allowed to speak about stocks.
All right.
All right, Ashwini, great conversation.
Thank you
Short,
so much.
but we look forward to seeing you more in person. Thank you very much and enjoy your weekend. Well, guys, with that, it's a wrap on this edition of Editors Roundtable from the entire team. Thank you for watching, but don't go anywhere. On the other side of the break, more news and updates will follow.